All right, this is Mr. Tiefenbach here. We're going to start Chapter 2 of our accounting class. If you haven't already either A, gotten a email account, well, then you wouldn't have been able to submit your Excel file here on my website. You're going to need to go to my website again here to go to Chapter 2. We have our lecture on 2.1, our lecture on 2.2, and our application problems at the end of the chapter. This is a pretty quick chapter, and we're going to go through it quickly. If you still have questions about Chapter 1, I would highly recommend going back through the lectures. I know these are a little bit longer than what the following chapters will be, but it's worth taking the time to learn the basics of Chapter 1 before moving on to Chapter 2. And again, also, you had 3 days to complete Chapter 1. You're also going to have 3 days to complete Chapter 2 and email me the completed Excel file by midnight of that third day. Okay, whenever you are starting this. So we're on Lesson 2-1 lecture. You're going to also need to, you don't necessarily need to download the PowerPoint notes, but I would highly suggest it as well as I go through the lecture. I'm also on page 24 of the book. Again, I'm on page 24 of Chapter 2 in the book, so I'd ask that you follow along with that as well. So here's my PowerPoint notes, and again, this is what you would download on this website here once it's linked, once I'm finished completing it. What you should know from Chapter 1, and this is kind of review quickly, we should know the basic accounting terms and accounting concepts related to starting a service business as a proprietor. And again, a proprietorship or a proprietor is someone individually who opens up a business. So if I were to open up a barber shop, or if I were to open up a cleaning service by myself, I'm the only one that owns the company. That's what a proprietor is, or a proprietorship. And again, a service business is a type of business that provides a service. Car wash, for example, you're buying a service. You're not actually getting a product back. Like if you were to go buy a pair of jeans or go buy a car, you're buying a product. A service business is someone that just provides a service, a hairstylist, barber, doing your nails, car wash, even teachers, doctors, things like that. They're providing a service and you're paying for that service. So make sure we know the basic accounting terms. You'd find that in your Chapter 1 Excel file. Just going back, I had you write out all the terms for each of the sections there. The next thing you should know from Chapter 1 is that we have 3 classifications of accounts: assets, liabilities, and owner's equity. Assets are cash, supplies, prepaid insurance, any equipment that you own, anything that you own as a business that is worth money is an asset. We could sell that off if we needed the cash for it. Liabilities are, it's a type of classification of accounts, and you're going to learn more about it today, of us owing somebody money because we bought maybe a truck for our business on account. We owe that person at a later date. We're going to pay them in installments or monthly payments, or maybe in 3 months I'll pay them for that. So that's what a liability is. It counts against what our company is worth. And then our owner's equity, which is our capital. It's what our business is worth. So in the grand scheme of things, our assets should always equal our liabilities plus our owner's equity. And again, these are just the account classifications. And we're going to learn, again, a little bit more about this in this chapter as well. From Chapter 1, we should have also been able to analyze how certain accounts are affected by transactions and how this affects the accounting equation. Again, this is the accounting equation. But each transaction that occurs in our business needs to be recorded, and it's always going to affect 2 accounts. Most likely, sometimes it's a plus and minus on the asset side, or sometimes it's a plus and plus over on this side, or a minus and a minus on this side. As long as the accounting equation that I'm circling right now is equal, then we know that we're okay. Finally, we prepared a balance sheet, and what a balance sheet is, it's the first official form. We usually prepare maybe every month or every 2 weeks. It's not something we prepare on a daily basis, and it analyzes our assets on the left side of the equation and our liabilities and owner's equity on the right side of our accounting equation in just a more formal document, so that we could present that to our boss, to our owner, or just me as an owner, be able to analyze that and know where we want to make our decisions in our business to make more profit. Okay, so again, a quick rundown of Chapter 1. As we go into Chapter 2, again, this is on page 24. I'm going to quickly zoom through this, and I know again that this is hard to read, so I would ask that you follow along in the book, but I'll point out certain paragraphs here with my mouse to kind of show you what I'm talking about. The first paragraph reads, a business activity that changes assets, liabilities, or owner's equity is known as a transaction. Okay, so any activity that happens where we're exchanging cash, or where we buy something and we pay them at a later date, or maybe we're paying a bill, like a telephone bill, cell phone bill, rent expense, the heat, the electricity, those are all called transactions. And again, they're going to affect two accounts always in our accounting equation. I'm going to kind of skip the second paragraph here, and on the bottom it says many transactions involved in the daily operations of a business increase or decrease our owner's equity. So again, our owner's equity is what our business is worth, but certain transactions can decrease what our business is worth and our owner's equity, or can increase what our business is worth towards our owner's equity. Okay, and we need to make a detailed information about those changes, and that's what we're going to get into today. I'm going to ask that you turn to page 26, and we're going to get right into the first transaction that we're going to talk about here today. So again, I'm on page 26 here. I wouldn't really worry about this top part quite yet. You can kind of see that here's our assets equals liabilities plus owner's equity. We've drawn a T account here. Here's our cash asset account, our accounts receivable kids time account, supplies account, and prepaid insurance account. Again, those are all things that are worth money. When we talk about the accounts receivable here, we're going to get to that right down here at the bottom. Again, our accounts payable are people that we owe at a later date. So we already have a balance here of $1,360. And then our capital, we are worth $10,000. So again, this side will always equal liabilities plus owner's equity, the right side. So first transaction is we received cash from sales. Again, we are Barb Trevino in this whole chapter, or whole first unit of the book here. Barb Trevino, she owns a music business, and she sells her services to give lessons to people to learn, probably kids, to learn how to play a certain instrument. So it says a transaction for the sale of goods or services results in an increase in owner's equity. So anytime we sell something, whether it be a service or a good, maybe we are selling an instrument to a kid, that would be a good, but we're still a service business. That's going to increase our owner's equity. It's going to increase what our business is worth. So an increase in owner's equity resulting from just the normal everyday operation of business is known as revenue, and you've probably heard that term before, revenue. Again, anytime we sell something, a service or a good, that brings in revenue. Okay, and that means we're making money. And again, the whole point of owning a business and starting a business is to make money. So make sure we know that term revenue. When cash is received from a sale, so when they write us a check or they give us cash, the total amount of assets and owner's equities increase. So again, I told you already that two accounts are always affected. We're going to increase our owner's equity. We're also going to increase our cash. And as you see here in this first transaction, that's what we're going to do. We're going to plus our cash. We're going to plus our owner's equity. That's revenue, what our business is worth. And those are the type of transactions that you want. You don't want to have to worry about someone paying you at a later date. You want the cash up front. Okay? So if you sell something, I'll take my $300 right now, whether it be a cash or whether it be in a check form. money order, whatever. So transaction 6, which is here on the middle part of the page, on August 12th, we received cash from some type of sale of $325. So instead of reading this paragraph here, we're going to increase the cash side because we received cash. We're going to increase this asset of cash, and we're going to increase our capital account or our owner's equity classification. The account name is Barb Trevino Capital, and we increased that by $325. We're going to write on the right hand side here, we're going to put a revenue. It was that type of transaction. The description is we received revenue. The second paragraph here, though, it says in this chapter 3 different kinds of transactions that affect owner's equity are described. So we're only going to talk about 3 here. Therefore, a description of the transaction I do want written here. We're going to do that in our problems that we complete for the chapter. Okay, so the second type of transaction, so the first one is we sold something for cash right there on the spot. The second one is we sold something, but they're going to pay us at a later date. Okay, and there's certain businesses that we might work that out with, or maybe certain people that can't afford it right away. Well, we'll perform the service now. I'll give you the lesson now. In a month, you owe me that amount, or maybe you pay half now and half later, or you set up arrangements. So this is called sale on account, okay, or sold services on account. Okay, and up at the top here it says Encore Music contracts with 2 daycare centers to provide music lessons to the children at the centers. So Barb Trevino travels to these 2 different places. These centers are allowed, she set this up, they're allowed to pay cash at a later date. Okay. When Encore Music sells services on account, we're going to record that in the accounts receivable account. And again, any accounts receivable, you're going to have multiple accounts receivable accounts as we go on. But again, the classification is that this is an asset. This is worth money. Even though we don't have it right now, they owe us that money. So eventually we will have that cash in hand. However, we're also, since it is revenue, we're immediately going to record it in the owner's equity classification of our capital account. All right, so you see the transaction there at the bottom. Transaction 7 says sold services on account to Kids Time for $200. So we're going to put $200 in our accounts receivable Kids Time account. So we'll just put accounts receivable and whatever company this is or person. We might again have multiple accounts receivable accounts. We're also going to record it as a revenue in our owner's equity capital account of $200. Okay, and when they pay us back, we'll get to that point as well. So that is 2-1. Actually, we're going to move on to the other 2 transactions, but to kind of give you a better look at this, again, we received cash from sales, so we recorded it in the capital. And this is the point where you might want to pause it. This is the transaction for transaction 6, received cash from a sale. And that's the 2 accounts that are affected are cash and capital. And again, our right side and left side are equal still. All right, so as we move on to actually, and this is the other one, transaction 7, received or sold services on account. Again, the key term there is on account, sold something on account. Again, we're going to still record it as a revenue type of transaction. We received revenue, but we haven't received the cash yet, so it's going to go under the asset classification of accounts receivable account. Again, you can see that both sides equal out, left and right side. Okay, page 27. The other 2 transactions we're going to talk about are paid cash. So the first 2, we received cash, or the first one, we received cash. This time we're paying cash. Anytime we pay cash, that means it automatically is deducted or minused from our cash account. I'm looking at the top of page 27 here. It says a transaction to pay for goods or services just needed to operate your business. So if you have a cleaning service come in, or maybe we have someone come in and tune the instruments for Barb Trevino's music place, those are services that we'll pay for, or maybe we pay them at a later date. We need things like toilet paper, receipt rents, anything that goes along with running a business. Those are called expenses. And again, those are going to decrease our cash accounts here. Okay. It's also going to decrease our capital, because if we pay cash out to something, we're no longer worth that amount as a company. So again, owner's equity is how much the company is worth. The capital is how much the company is worth. Well, if we pay cash out to something, we're no longer worth that amount. So, looking at the first transaction here, transaction 8, August 12th, we paid cash for rent. We rent a building out, so every month we have to pay for that building, just like if it was an apartment or a house that you were renting. And how we look at that transaction here, make this a little easier this time. We paid cash for rent, so we're going to deduct $250. Most likely we wrote a check out of our business checking account, not our personal checking account. And again, the expense is going to come out of our capital. The next transaction on the same page there, looking at transaction 9, says paid cash for telephone bill. It's the same exact thing. We have a rent expense. We have a telephone expense, like a cell phone expense. So it's going to be the same type of transaction. Minus $45. We probably wrote a check for this, and we're going to subtract it from our owner's equity, our capital account as well. And still, these two amounts equal out. Assets equal liabilities plus owner's equity. Moving along, trying to get quickly here. The last two transactions are kind of a little bit tricky here. We're going to receive cash on account, and that's this section right here, received cash on account. So when a company receives cash from a customer from a previous sale, so if we go back up to this transaction here, transaction 7, we sold services on account for $200 to Kids Time. Well, eventually they need to pay us back, and that's what we're going to record here in this transaction right here. So we received the cash on account from Kids Time for $100. They're only paying us half, which is okay. It's probably part of the agreement. So let's take a look at this. We received the cash of $100, but we're going to subtract it from what they owe us. So now they still owe us $100. So we increased and we decreased the same amount of an asset. Therefore, our balance is still going to equal out. Okay? So whenever someone pays you back, this is where this is recorded. The other transaction is paid cash to owner for personal use. So we've made our revenue, we've sold all these services. Well, now I want the cash to be able to spend that cash. I want the revenue. So we call that transaction paid cash to owner for personal use, or just paid cash to owner. These are called withdrawals, and it's just like withdrawing money from your bank account. We're going to withdraw the revenue from our business account, and maybe we put it into our personal checking account, or maybe we pocket the cash and go on a vacation. Whatever. Maybe we take that money and we reinvest it into our business to make more profit. So those are called withdrawals. And anytime we do this, for example, on the 11th, the owner, which is Barb Trevino, is taking out $100 in cash. So she's withdrawing from this cash account at her bank. Well, again, since this is we're decreasing our asset, we're going to decrease the owner's equity of what the business is worth. We no longer have that $100 in the bank. Our business is no longer worth that amount. Notice that the owner's equity is more than cash because all of our assets equal up our liabilities and our owner's equity. This type of transaction is called a withdrawal. So we have three different type of transactions from the owner's equity. We have withdrawal, we have an expense where we pay out, and then we also have revenue where we're selling something either by cash or on account. So revenue, expense, and withdrawals. Those are the only transactions. Those four transactions are the only ones that we're working on in Chapter 2. If you want to kind of read through here this last section of the summary of some of the changes that we made in the owner's equity account, that's here on the bottom of page 28 in this section right here. So and also you can pause this, rewind this, replay this, however to kind of help your point here. Let's talk about page 29 here. 2-1 terms review. Again, revenue, sale on account, expenses, and withdrawals. Make sure that we have that once you've downloaded the file. You can put them right here, and it should go in red for you, and just answer it all the way across. Answer each question, or I'm sorry, fill out each term here on this form. Make sure that you save it. And then also the audit your understanding, put it right here, run it all the way across, and make sure that it's in complete sentences, please. The work together on page 29, which is what you see here, and I'm going to walk you through this. The instructions say write the answers to the following problem in the working papers. This is what the working papers are. Place a plus in the appropriate column if the account is increased. Place a minus in the appropriate column if the account is decreased. So let's take a look at the first transaction there of the work together. We have received cash from sales. So again, I've already formatted this for you. Shift plus sign. We're going to receive cash from sales, which again, going back to the chapter, the two accounts affected are cash. We received cash, and it's revenue. Okay. Transaction 2, sold services on account to Bowman. Oops, I always do this. Hit enter. So we sold services on account to Bowman. Again, this is revenue. We sold the services. We just didn't receive the cash right now. Hit enter. So we're going to plus this as well. Hit enter. That way the formulas won't come up for you. Transaction 3, paid cash for telephone bill automatically, minus cash because we paid cash. We're also, since it's an expense, we're going to take it out of our capital. Make sure we hit enter. Fourth transaction, received cash. Automatically, you can know, put a plus sign there. Received cash from Bowman Company. So we're going to minus it out of Bowman Company. So both sides of the accounting equation, assets equal liabilities plus owner's equity, are still going to equal out. I want you to do the on your own just from looking at, those are the 4 transactions that we talked about in the PowerPoint presentation and the lecture. You should be able to do this on your own. It's formatted to put the plus and minus signs. That is the end of 2-1. I apologize for it being